Hi, my name's Alex. I'm a CPA with Stronghold Accounting, and not knowing how to read your financials is like driving down the highway with a blindfold on as a business owner. And I want to talk about how I personally look at the P&L and balance sheet every month, as you should be too, and what to look out for when you're reviewing these reports. So let's start with the profit and loss. The profit and loss is the business owner favorite report. It's the one easily understandable to everyone. You start with your revenue, then you go with your expenses that go out the door, and you're left with your net income. It's a portion of time, right? So you can review on a monthly basis, quarterly basis, an annual basis. And what I look for with the P&L is what I call the profit margin trifecta. This is going to be your three margins: your product margin, your gross margin, and your net margin. What do these mean? Well, quite simply, your product margin is your revenue minus your direct cost of goods sold. So whatever was directly attributable to producing that revenue, that would be considered your direct cost of goods sold. So looking at your revenue minus direct cost of goods sold gets you a really good indication of, hey, what am I left with after those direct costs? Now, the second thing is called your gross margin. It's the same calculation, except instead of just removing your direct cost of goods sold, you also remove your direct labor. So revenue minus direct COGS and direct labor gets you gross margin. Now, this is one of my favorite metrics because this really gets at what is the core engine of my business producing: direct COGS, cost of goods sold, and direct labor. And what am I left with, right? Am I left with 50+% margin, 60+%? Depending on the industry, this will definitely matter and is something you really need to drill into in terms of, hey, is my labor force optimized? Are they working efficiently? Or do I need to hire someone new, right? Are they overburdened with work? And that labor efficiency is really where you can start to play with that margin. So tracking that direct labor separate from your cost of goods sold is really important to tracking that gross margin and optimizing it. So that's the second piece, your gross margin. The last piece of the P&L is your net margin. That's the same metric of gross margin, except your operating expenses, right? Rent, utilities, marketing, management labor that we don't include in direct labor, other operating expenses. That's going to get you to your net income. And that is the ultimate indicator of, hey, what is left? And if that's below 10%, we need to work on that, right? If you're close to break even, 10 to 15% or more, depending on the industry, some industries, 20-25+% net margin, meaning if you sold 100,000 in revenue, you're left with 25,000 in net profit. So these are some metrics that you really need to be looking at when you're looking at your P&L. And one extra tip that I want to add is when you're looking at the P&L, try to look at it instead of month over month, do what's called a rolling 3 or a rolling 12, where you're combining multiple months into one column. And the reason I like to do that is because there's ebbs and flows of the business month over month, right? There can be very big ups and downs depending on one-time expenses, one-time bulk revenue deposits. And so smoothing that over a 3-month period or even a 12-month period, which would be rolling 12, that allows us to gauge the margin more accurately. And so that is how I look at the P&L. Profit margin trifecta, product margin, gross margin, in net margin. Now, moving on to the balance sheet. The balance sheet is kind of like a camera. It's a snapshot of a point in time, right? Whether it be end of December, beginning of January. It's not a portion of time like the P&L where you're looking at January 1 to January 31st, right? And so when you're taking a snapshot of a business, key items that I look at is number one, your cash reserve, right? So do you have too much cash? Do you have too little cash in the business? A target that I look at is 2 months of operating expenses and direct labor. So you take your operating expenses and direct labor for 1 month and you multiply it by 2, and that gets you your target cash reserve that you should have on hand. Now remember, you don't want too much cash. Too much cash is not good because that's an opportunity cost. You could distribute that, you could put it back into the business, invest it into the S&P, into a retirement account. And so we don't want too much. So cash reserve is a really good metric I look at. AR is big, accounts receivable. Who owes us money, right? And how overdue are they? Do we need to follow up on customers, right? Making sure we have good AR and collections is going to help ease our cash flow. AP, who do we owe, right? Can we maximize our terms for vendors where we're collecting faster than we're paying out our vendors? And that's going to help our overall, what I call cash burden of the business, which is how much money is the business eating at a point in time? And if we can optimize our accounts receivable to collect faster and our accounts payable to pay later, we're optimizing our cash position so that we can grow the business more sustainably without outside financing. And so I think that's good for the balance sheet. I don't want to go too much into detail, but I hope that was helpful. Now, Now, we help businesses construct these financials because a lot of times they just don't have the right data to begin with. And so we help construct this and also analyze this alongside the client on a quarterly basis live. And we do that through our CPA system, which is a flat weekly subscription. So if you're interested in that, you can check that out through strongholdaccountants.com/free consult. Thanks so much for watching. Take care.